This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, we wrap up one of the better weeks in the market for a long time. We'll look at what this means for the future, and we'll review a holding in the core portfolio. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. We just had quite a week in the markets. One of those weeks that they use as a lesson against you timing the markets. It's this kind of week that if you miss out, well, just missing this week alone radically affects your annualized returns. And this is one of those times I'm very aware that I'm recording this show with some trading left to do before you probably get a chance to listen to it. So if the market crashes on Friday, just go ahead and delete this and go back to YouTube and pull up old episodes of Louis Rukeyser. But as of now, since last Friday, the S&P 500 is up about 2%. And more impressively to me, the RSP, that's the equal-weighted version of those same 500 stocks, it's up 3.5%. So despite some really large moves in those big popular tech stocks, this was a really nice broad-based rally. A big part of that was actually the banks, since this rally really was interest rate driven, and the drop in bond yields led to a pretty sizable rally in the bank stocks. But for the month of November, after folks were certainly feeling a bit ill after nasty September and October in the markets, the S&P 500 has now rallied 7.5% since Halloween. And on Wednesday, beyond this rally in the stock market, the Wall Street Journal led off with an article that really captured the drivers behind the enthusiasm that drove stocks higher, as the lead story was, quote, "The elusive soft landing is coming into view," end quote. And the article went on to read, quote, "The U.S. economy is approaching what most economists had thought either unlikely or impossible, inflation returning to its pre-pandemic norm without a recession or even much economic weakness, a so-called soft landing," end quote. And now, is this what we're seeing? Are we seeing inflation reduced to below normal levels, approaching the Fed's 2% target rate in a comfortable, gradual descent, slow enough to avoid even really much of a bump when we get to hit that runway? Well, for most of 2023, the Wall Street consensus was that we'd be heading into recession to finish this year, or at least to begin next year. I'm still getting those questions a lot because that kind of got ingrained in people's minds, and that we'd also see the Fed then start to cut interest rates. Remember, we talked about this a lot. The consensus was that the Fed was going to cut interest rates by the end of this year, basically where we are now. And you can look it up on the archives of the show. I was on the record many times on the podcast saying in the first half of this year, there just wasn't a clear path to that on the economic calendar of data releases, short of a major economic catastrophe that would require a major policy shift and emergency Fed action. But now, the market is now pricing in 2 rate cuts. That's the consensus, 2 rate cuts by next July. And I'm not going to sing from the same hymn book here. That is a little bit more viable. Maybe a little bit bullish, but more at least feasible. We are seeing inflation dropping pretty dramatically year over year, really big time. And the bond market's doing a lot of the Fed's work for it. Now, Jerome Powell, who was the first Fed chair in over 40 years, who actually was not an economist, he's an attorney, may either through the actions he's guiding here or maybe through happenstance, but by the end of this, he may be getting the Nobel Prize or at least be remembered for being the economic equivalent of Captain Sullenberger landing that airplane on the Hudson. Because as that Wall Street Journal article points out, and why it was so easy for so many to forecast a recession, in over 80 years, the Fed has never once been able to tackle inflation by raising interest rates without also evoking a recession. Now, the Fed has remained largely transparent, and they've telegraphed their moves, and recent inflation data has suggested that we are gliding to that 2% inflation target, more or less. The Fed's representatives have still continued to say higher for longer. They're emphasizing that even if they stop raising rates now, that they're not going to be in any rush to cut them, but might they, through a cut in the overnight rates into the mix, throw one out there in the next 6 to 8 months? Well, we got on Thursday higher than expected new jobless claims. That is one more data point that lends to that thesis. And it's hard for me to believe that they would start cutting rates without a bit of a concern for the economy, that maybe a concern that they've done too much. They're not going to do it just because they've gotten to their inflation target. They might have to be concerned that they saw unemployment rising a bit, which flies a bit in the face of this victorious soft landing approach. But, unemployment rising a little bit is not the same as a recession. But if we do get a bit of softness, it's hard to believe that it would be a minor blip and that a similarly minor cut would be enough to immediately reverse the course. It's just not that nimble. But yeah, I do believe we can avoid recession, that we're not likely to see the 2 or 3 or more subsequent quarters of negative GDP growth, with that tiresome discussion returning to the show of what's officially a recession and how by the time it's official, it's already over. And while the consensus 6 months ago on Wall Street was that there would be a recession within the next year, the same folks polled today do not forecast a recession. So it's a bit unusual to assume the Fed would therefore be cutting rates, because they don't need to. There's nothing, they don't need to add additional support. But it's more likely that when they've assumed that it's more possible than when 12 months ago they said they'd be cutting by the end of this year. There is at least that runway to that answer. A big chunk of the work required is actually happening globally, which is good for us. It's not weakness here, but it's the strength of the dollar and many other factors, some of them terrible in nature, these kind of geopolitical horrors we see every day. But it's also the Fed's actions that have actually strengthened the dollar versus other developed economies. And while China is now showing this more magnanimous face when dealing with the West, and they're expected to go a lot further to try to reverse the decline in their economy, it's this slowdown in China and Asia overall that, for one thing, may help alleviate inflation and keep the American consumer afloat, as we'll be paying relatively less for imports with our strong dollars. And two, it may also crack open the door for the Fed to back it up a couple of notches at least, without this real need to start a new policy course, which would be the first in a series of long series of rate cuts. That would be a major policy shift, which I'm a little bit more skeptical of. But they could see some global softness and the dollar may be getting too strong, and them saying, all right, well, let's take our foot off the throttle a little bit here, and that's maybe more viable. That's the likely scenario now, which is a bit of a Goldilocks outcome, whereby the Fed isn't going to take us back to the period of quantitative easing, 0% overnight interest rates, but they back off maybe 50 to 100 basis points and settle in at a comfortable equilibrium point, whereby we'd have to then also hope that along with that, we get capital that's more widely available, and the spreads to these benchmark rates normalize. So it's not just that the Fed's overnight rates and the benchmark treasury rates are a bit lower, but that the spread to them, how much more a mortgage costs or businesses' borrowing costs, that they back up a bit, and that a subtle backup in Fed rates results in a magnified reduction in the overall cost of borrowing. And I'll be, nowhere to the low rates that we saw a few years ago. So you're not going to refi your mortgage that you got 2 years ago anytime soon. But this is important for stocks, not because it's changing the perception of these analysts' forecasted earnings, but it's changing the value of those future earnings. Wall Street relies upon itself, not the Fed, but their own selves to guess at what the forward estimates of earnings will be. Or maybe in many cases, they're spoon-fed those estimates by the companies. but that may be. But it has to then discount those estimates of future earnings based upon prevailing rates. So they try to guess at where interest rates will be, despite it being hammered into you over and over and over again that it's a fool's errand to guess where interest rates will be. Now, before this week, and it's pretty bullish inflation data, we got consumer price index releases and producer price releases, which both suggested lower inflation and were lower than the estimates. And these were the catalysts that drove stocks substantially higher. But before that even, analysts were pricing in earnings growth for the first quarter of next year, overall market earnings growth of 6.7%, and for the second quarter, 10.5%. But with also pricing in lower interest rates, they can now look at these earnings and beyond those with a higher valuation or a higher premium that you're going to pay for it, even though the estimate itself might not change, as the future is that much more valuable in today's dollars at lower interest rates. And I'm not saying those earnings estimates are out of control either. And I have kind of been a skeptic about year-over-year earnings growth somewhat lately, but we also have to be judicious, I guess, and realize that they're measured versus some very soft quarters earlier this year. So the year-over-year hurdle is pretty low. I'm just trying to lay out that this soft landing scenario, what it looks like, and also that while it is very bullish for stocks, it does not represent a return to the emergency rate policies that we faced almost entirely from 2008 through 2022, with a little bit of backing off and then a returning to those policies again during that, 14-year time frame. Really, we only had some moderate attempts to exit them after the great financial crisis and ultimately had to return to them. Even quantitative easing really continued throughout that whole time. But according to FactSet, at the corporate level, because I was talking about the earnings estimates for the market, but at the corporate level, estimates are now in the first quarter, to pick on some notable names here, they see Amazon growing earnings in the first quarter by 112% year over year, and Alphabet, formerly known as Google, to grow theirs by 27%. And in the second quarter next year, standouts that they have are projected to be Merck, growing their earnings. They were negative $2 and change this year to positive $2 and change. And these are all companies I own, by the way, and which we own for our clients' portfolios. So highlighting them as is definitely here as a conflict of interest, and that I benefit from these names doing well. But I also highlight them to demonstrate that a year-over-year metric can be pretty remarkable when using a specifically weak point in time, which is going to be an ongoing theme for 2024. The hurdle for year-over-year comparisons is very low, and many stocks will be facing very easy comps. And while I've highlighted names here that we hold, I didn't pluck them from a list of 500 names in the S&P 500, but from FactSet's Earnings Insight Report, which singled out these names along with a few others that I haven't mentioned here. So with that said, all right, I'm going to take a few moments for a break here. But when I return, a little bit more on what's driving the bullish return and the return of the fear of missing out on the stock market, and also a reasonable bit of what can go wrong and why you should avoid that FOMO. And then we'll get into some specific stocks names. So for the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So, as we round out what was one of the better weeks for stocks we've seen in some time, we've got to also wonder, well, how much good is now priced in? And I had a conversation this week with someone about one of the most widely traded and biggest gaining stocks this year. And all they heard was good things about the company. And of course, they were struck with the remarkable year-to-date return on this stock, which led them to covet some shares with that fear of missing out and wanted to participate in it. And they wanted to buy this company ahead of its earnings report, which is going to be released just around the corner. Well, it's hard to dismiss the thesis. The company is getting, I'll say, 110% out of their warp core here and sailing at absolutely full velocity on the business level, not just the stock. The only reason, though, to hesitate is that all of these reasons to like it are not just publicly known, but also featured front and center in the financial press. So the stock is reflecting a lot of that hype already. It's in that price. And they've got to really absolutely crush it again to get that kind of Robert Goddard escape velocity to keep going even beyond now. We don't hear it much recently, but I remember the late 90s, they used to always talk about, well, here's the earnings estimate. Did the company beat its whisper number? Thankfully, we don't have to deal with that too often anymore, but still. So how much is already in that price? And this is somewhat analogous with the overall stock market right now, as at least with the concentrated version of the S&P 500, it's already priced in a lot of good already. That in its price is the soft landing estimate now, not the recession is inevitable estimate. It's priced in lower interest rates, a more resilient economy, and strong earnings growth. And as a case in point, Goldman Sachs just released their 2024 market forecast. And I like Goldman's research. I use it, but I also recognize that they have a historic reputation of being more typically bullish. But when we look at their forecast now for the markets for next year, we see that they expect the S&P 500 to be at 4,700 by the end of next year, which is roughly a 5% return from where we are now, or a 6% return with dividends. Now, they've been an outlier all year, and they've been right. They've been saying that the economy is going to avoid recession, but while they're still generally bullish on the underlying conditions here, they conclude with these modest estimates because a lot of that good now is the consensus. It's already reflected in the price. They go on to point out that they're a bit more hawkish than the street on interest rates, as they're expecting the Fed to hold steady until late in 2024. And the conclusion is aligned really with my own takeaway, which is that the market as measured by the S&P 500 may have already assumed a lot of the outcome in this price and this valuation here at over 18 times next year's earnings estimate. But beneath the surface, there are still better opportunities in more appropriately priced stocks. One area that may afford such opportunities may be in the pharmaceutical sector, although I have to be mindful that the election might be a player on this one. The headline assault on drug prices may very well take a prominent role in the campaigns next year, although probably, again, without ultimately having any substantial changes there. But a lot of the big drug stocks took off this year after actually having pretty strong runs over the last few years, actually bringing pretty good returns in many cases during last year when overall the market sold off. And one which we've talked about for years on this show, which I personally own and I own for the client, so it comes with those standard conflict of interest caveats here, and that is AbbVie, symbol ABBV. Now, AbbVie is on the front line of drug price competition, as their primary product, Humira, is very expensive, and it's a featured name in these attempts to reel in prices, at least for Medicare. But either way, 2023 has been a year of consolidation for the stock, which is now priced at 12 times next year's consensus earnings estimate, according to FactSet, and has a current dividend yield of 4.5%. Now, if we jump into Mr. Peabody's Wayback Machine, we'll see that while the stock, it's down 14% this calendar year, but it's still up 2% from that first week in 2022, when the S&P 500 hit its all-time high, which now still remains 6% below that mark. But on a valuation basis, AbbVie is really about the same level it traded at those 24 some odd months ago. And relative to the S&P 500, as well as versus its own historic multiples to earnings, it's still above its trough levels, which were actually made around 2020. So I'm not going to say AbbVie is cheap here today. The Humira patent story is really unfolded this year. They have now what is basically a generic competitor. It's taken away roughly 25% of the sales from that drug. And the shareholders now look forward to contributions of other drugs to try to eclipse that impact. Namely, there are two newer big drugs, which is Skyrizi and Rinvoq. You'll see, the only reason I know how to pronounce them is that you see commercials for them every day. But still, estimates for those two combined aren't forecast to exceed Humira's total contribution in the foreseeable future. They are eclipsing the diminished amount of Humira sales, but not Humira overall. That's still what is most important there. And FactSet estimates don't show AbbVie actually exceeding its previous peak in sales, which was in 2022, which was $58 billion in sales, until about 2026, when the Wall Street estimate is that AbbVie will earn $60 billion in sales and go upward from there. Goldman Sachs emphasized this in their reaction to the recent earnings report from AbbVie a few weeks ago, saying that Humira's sales declines were in line with estimates and that, quote, Rinvoq and Skyrizi are providing propulsion to the upside, end quote. They, who are neutral on the stock for what it's worth, go on to say that it looks like $11 a share in earnings in the estimate and the guidance from the company appears to now be the actual bottom, and that the guidance appears to be prudently conservative. Well, at this point, downside risks, I would say, are largely from the pricing side. If Medicare really did get some teeth on pricing competitiveness. And to the upside, it's not necessarily from greater adoption of these existing therapeutics, but instead from additional successes from their drug pipeline, coming out with some new successes from there. Ultimately, neutral is probably about right for this name today. It's modestly priced. It offers a handsome and growing dividend and probably some insulation from a broad market that overall may not be offering a lot of big upside from here today, as I was saying. So neutral, and a name and in a sector that if we do see a little of this euphoria cook off of the markets, that's an area where we can look for value. All right, that's it for me today. I appreciate you listening in. I hope you all have a wonderful Thanksgiving, one where we can show patience for our loved ones and love for the Cowboys. For the Wise Investor Show, I'm Chase Hinderstein. Have a great holiday.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.